Okay, good morning. Today we're going to finish up Chapter 11. As I said today, I expect class will be a little shorter than normal because we don't have that much left in the chapter, so we're going to get started. We're starting with there is a question in Learning Catalytics. Make sure you're logged in as usual. Our final exam is coming up during finals week. It is over chapters 9 through 13, the learning objectives that we covered. I've edited study plan and the practice exam so they don't include learning objectives that we have not covered. The final exam is available Monday, finals week, starting at 9 a.m. through Friday at 12:30. You have to finish by 12:30, so that means to get the full time you would need to start by 10:30 on Friday. So you need to finish by 12:30 on Friday. Sections 1 and 2, you take it in the computer lab. Again, we have no way to predict when lines will be, but we do know there are thousands of exams being administered during finals week. Usually, generally, rule of thumb, early morning, you don't have to wait in line, usually. Sections 5 and 6, ProctorU is swamped during finals week because they're proctoring all over the country, so make sure you schedule your exam early so you pick the time that works best for you rather than being at their mercy. Okay, the first question today, we started Monday with it. If it looks familiar, the purchase of treasury stock by a corporation increases total assets and stockholders' equity. So if you think about this, if a corporation purchases treasury stock, that means the corporation is using cash. Okay, so cash is an asset. If we use cash, what happens to assets? That will be enough to answer this question. Okay, very good. Okay, so the purchase of treasury stock by a corporation increases total assets and stockholders' equity. That, of course, is false. Okay, because the purchase of treasury stock causes total assets to go down, causes total stockholders' equity to decrease as well. Okay, that question will remain open for a minute or two until we get to another one. It will only be open for about another minute or so. Close it before we do the next one, whenever that is. Okay, let's do this Saturday Chapter 11 homework, and that brings us then into Chapter 11. Okay, as a reminder, Chapter 11, we are only doing learning objectives 1, 4, 5, and 6. Haley, I'm going to a slide now. I'm going to skip what you have right there. Okay, so what we're going to do is we have one learning objective left in this chapter. There are no computations in this learning objective. It is conceptual in nature. This is one of those learning objectives that you should read the part of the chapter carefully. This is one where it makes sense to make flashcards because it isn't something you compute or apply. This is talking about the difference between management's responsibilities and auditors' responsibilities. When we talk about management, we are talking about the management of the corporation. Okay? So whenever you see management, it refers to the corporation. When we refer to the auditors, unless told otherwise, the auditors refer to that independent third party that comes in and examines the company's books and what they did. So we've got management, that's management of the corporation, and then we have the auditors that come in. One time someone said, well, doesn't the auditors have management? We're not referring to the auditors' management. That's a separate issue. We're talking about the management of the corporation and the publicly issued statements the corporation provides. The auditor comes in and examines not all the transactions, but examines the systems, examines the numbers, examines some of the transactions, and forms an opinion on whether those financial statements fairly represent the results of operation. So when we talk about management's responsibility, management's responsibility is it has to, first of all, issue a report on and take responsibility for internal control. Internal control is that system within a company that has safeguards. It's designed to safeguard our assets. It says that the same person doesn't reconcile the bank statement that writes the checks, for example. I'm going to add something to this slide too. Management, in addition to being responsible for internal control, is also responsible for financial statements. So management is responsible for internal control. Management has this responsibility to state that it's applied this internal control framework, and internal control is effective and it's been audited. And also management is responsible for financial statements. Okay, now, so management has responsibility for internal control. Management has responsibility for the financial statements. Management cannot say it doesn't understand accounting. When Enron imploded, the management, the CEO's defense, because what happened with Enron several years ago is Enron was going along and it was Wall Street's darling because it was making tons of money. Some people didn't quite understand what it was doing, how it made money, but it continued to make money until one day it started to unravel. And what they found happened with Enron, basically, is Enron would decide what income it wanted or how much it wanted to make from various projects. So they would start with that. They would say, we want income to be $1 billion. How are we going to make that happen? Well, to make that happen, let's do this project, and this project. So each of those projects has to return $200 million or something like that. So then they would make up the journal entries to make that happen, is essentially what Enron did. They started with where they wanted to be and then made up the entries to get there. Okay? So they were making up entries. They were making up their own accounting rules. They were doing anything just to get to the bottom line. So one day it all unraveled, and that's fine. But the CEO of Enron, his defense, because the government went after him and wanted him to pay for this, to say, you know, all these people lost their investment. We have people that lost their entire retirement because it was in Enron stock. So they wanted him to pay at least jail time or restitution. And his defense was he wasn't an accountant. He didn't know any better, that it looked fine to him. You know, that was not his problem. It was the accountants, specifically their auditors. So then there became this question about where were their auditors. Their auditors were Arthur Andersen, which was one of the big 5 accounting firms, and Arthur Andersen had offices in Enron. Arthur Andersen partied with Enron. Basically, Arthur Andersen became not independent, and they let these things go by. Arthur Andersen ended up going out of business, and this was shocking because it was one of the big 5 firms, and all of a sudden it didn't exist anymore because of Enron. But the CEO's defense of, it's not my fault because I'm not an accountant, the government, the U.S. government promptly passed an act called SOX, the Sarbanes-Oxley Act. And what that act did is it made management responsible for the financial statements and for internal control. So now a CEO, so if you're planning to have your own business, you do not have the defense of saying, or if you're a top manager, you cannot say it's the accountants or I don't understand accounting. You are responsible. So today, the CEO of Enron would absolutely positively be responsible for the entire financial statements. So now managers and executives have a lot more responsibility. They have to own the numbers because they're responsible for them. Management is ultimately responsible. Those are management's financial statements. That's management's internal control, so they have to attest to this. So that's management's responsibilities. So then we have the independent third party, the auditor. What are they responsible for? This auditor, it's a certified public accounting firm, CPAs, they look at the financial statements of publicly traded companies. So all publicly traded companies have to be audited, and the auditors determine if the statements comply with GAAP or with International Financial Reporting Standards. They test internal control. So management's saying we have internal control. The auditors test it and see if it meets standards, and then they issue a report on the financial statements and internal controls. Auditors are like the bedrock of the investing system, because if we didn't have auditors, we could have very, very little faith in these companies that we have no connection to. These companies, there's big dollars involved, and we wouldn't know if the companies were following the rules or not. So auditors are in there. They're being our watchdogs to make sure things appear to be right. Okay, so the auditors go in and test things, and they go in and they say, yeah, it looks right. An audit never guarantees you that everything's right. They don't look at every transaction because there's simply not enough time. They do sampling. So they'll go in and they'll test it and they'll say, it appears that it looks reasonable. What we're going to do now is it's time to put down the pencils. You don't need to write down. You don't need to memorize what we're going to do now. What I'm going to do is I'm going to show you Smucker's reports. They're not their financial reports, but the reports from management and the reports from their auditor, and show you what's in there. So you don't need to memorize this. If you're interested and you want to look at this later, you can get any publicly held company's financial statements from their investor relations part of their website. You can also go to the SEC website. They have a database called EDGAR, and you can search for companies that way. But when you get your annual report, an annual report is also called a Form 10-K. And the 10-K is usually anywhere from 75 to 200 pages. I would say most of them that I see are in that 100 to 125 pages long. So when you open it up, the very first page is the cover page that tells you the name of the company, and it's the filing information for the SEC, so you don't need to worry about that. And then the next several pages are management's discussion and analysis, which that's where the company is telling investors about their company, about how great it is, but it's also MD&A, that's called Management Discussion and Analysis, is governed by very strict rules. So companies agonize over every word in there. My husband used to help write the MD&A for First Energy, and it would take a couple months, and it would go through so many proofreading. The attorneys would have to review it several times. So it's very, very well crafted. So this MD&A goes through, and it's rather free form. Okay, they tell about what's happened in the past, what's going to happen in the future, the risks they face, and there's rules about this too. So they can't just make it all rosy. They have to put some real life in there. So MD&A goes on for a long time. They talk about compensation of officers and things like that. And then they get to the financial statements. Financial statements are item 8. So there'll be items 1 through 7, which are listing up officers, the MD&A, all kinds of things. And then you get to item 8, which is the financial statements. Financial statements include 3 main parts. Every financial statement is going to include the letters from management and the auditors. So you will see these letters that I'm showing you are from Smucker's annual report for 2014. Then you will have the financial statements, the 4 that we've talked about, the statement, income statement, statement of stockholders' equity, the statement of cash flows, balance sheet, and then statement of comprehensive income. they'll all be in there. And then the notes to the statement. And the notes to the financial statements, I brought in excerpts of those where they tell you the life of their asset categories, what do they have realized or unrealized gains, things like that. But these are, what we're looking at today are the reports, the annual report, and these are the letters. So the first letter, and I'm going to blow these up. So the first letter, I'm just showing you, just as a bird's eye view, this is the letter that's the audit firm's report on internal control. Okay, so it's fairly long. These are boilerplate letters. I'm not going to blow this one up. I'm just saying there's the report, the auditor's report on internal control. Next up, we see the audit report on the financial statements. Now, this is very much boilerplate. These letters that you're looking at are dictated. They are pretty standard. If you look at one company's letters, it's probably going to look the same as another company's letters with just a few words replaced. That's because the language is very much dictated by accounting standards, auditing standards, and regulation. So this is the report of Smucker's audit report over the financial statements. First thing you see is the audit report is addressed to the board of directors and shareholders. The audit report says, here board of directors, here shareholders, because shareholders are the owners of the company. So the audit report is addressed to them. We also see on here, another thing that we see on here in the lower left-hand corner down here, let me show you. Down here, we see that is Akron, Ohio, and it says June 23rd, 2014. That is the audit. That's the auditor's date of completing this letter, of completing everything with the audit, June 23rd, 2014, and Akron, Ohio was the office that did it. And then we'll see the name of their auditors right here. This is the signature of Ernst & Young. Ernst & Young is one of the big four accounting firms. So there's that basic information. And what we're going to do now is I'm going to go through paragraph by paragraph and talk about what's in this letter, because I think it's important to see it. You don't need to memorize it. You will be reading the section carefully. So, you know, you've got the section headings. But the first paragraph, this is the audit report. So this is the report that's going, this letter here with the 4 paragraphs, it's from Ernst & Young, it's to the shareholders, and it's the report of from Ernst & Young on the financial statements. So the first paragraph says that we have audited the financial statements. That first sentence there, that very long sentence, tells us what they've audited, what statements they've audited, and the period of time that they've audited. Okay, so that's the first sentence. The next sentence says, these financial statements are the responsibility of the company's management. The big takeaway from this learning objective is that management is responsible for the financial statements. The auditors are not. The auditors do not do journal entries. The auditors do not create the financial statements. Management does. Management, of course, hires the accountants, and the accountants report to management. So the financial statements are the responsibility of company's management. Our responsibility is to express an opinion on the financial statements. So the responsibility of the auditors is to say, are these financial statements legit or not? Okay, so that's paragraph 1. Paragraph 2, it tells us that that Ernst & Young has conducted their audits in accordance with the standards of the Public Company Accounting Oversight Board. That's the PCAOB. That came out of the Sarbanes-Oxley Act that happened after Enron. This is an oversight board over the auditors, because there was a lot of angst after Enron about where were the accountants, what was Arthur Andersen doing, and the accountants, the auditors, need to report to someone as well. So the PCAOB oversees auditors. These standards require we plan and perform the audit to obtain reasonable assurance that whether the financial statements are free of material misstatements. Okay, so that reasonable assurance. An audit does not guarantee that there are no errors. An audit does not guarantee there's no fraud. It's a lot less likely after an audit, but an audit is only designed for reasonable assurance. It would be cost prohibitive to test every single item. It just simply cannot be done. So it's reasonable assurance. And then the next sentence tells us what an audit does. An audit includes examining on a test basis. They're sampling the transactions, evidence supporting the amounts and disclosures. So the auditors are looking to make sure those financial statements represent reality, but it's only reasonable assurance. There is no guarantee. Okay, and then, okay, so that's paragraph 2. Paragraph 3, again, this is the letter from the auditor to the auditors to the shareholders about the financial statements. This is the big one. This is the big money. In our opinion, the consolidated financial statements referred to above present fairly in all material respects the consolidated financial position. Okay, this is what Smuckers wants. They want this opinion that says this presents fairly. Okay, that presents fairly, that's what they're looking for. There are no issues. This is referred to, and you will need this term, this is referred to as an unqualified opinion. Okay, unqualified, which we're going to have, I think we have a question on that, and it's not a trick. Unqualified is the opinion you want. Unqualified means there are no qualifiers. Okay, if we had a qualified opinion, it would be everything's okay except for this or this, and those are two qualifiers. So a qualifier in this use of the word means that there's exceptions. So an unqualified opinion is what you want. An unqualified opinion is a clean opinion. The unqualified terminology is going away, but it isn't quite gone yet, so that's why we're still talking about it. But for years and years and years, we've been going, why is it called unqualified? Because that sounds like the auditors don't know what they're doing. That when we're using the term unqualified with an audit, that's what you want. You want a report that has no exceptions. And that's what Smuckers has here. Ernst & Young has issued an unqualified opinion, meaning they didn't find anything material. Now notice that they're saying material respects. They're just saying that, you know, there could be little errors here and there, but they would not influence an informed investor. It wouldn't make any difference. Okay, so, and then at the bottom it tells us it's in accordance with U.S. GAAP. Okay, so it could also say it's in accordance with International Financial Reporting Standards if that's what the company uses. Okay, so this is paragraph 3. This is the audit report from the auditors to the board of directors and shareholders of Smuckers. And then the last paragraph, it's telling us that they have audited the internal control as well, okay, based on this internal control framework, and that's okay too. And the very last sentence says, our report dated June 23rd, 2014, which is this report, expressed an unqualified opinion. There's that terminology. Unqualified opinion. That's what you want. An unqualified opinion means they didn't find any material issues. So unqualified opinion is what you want. It has no exceptions. It is a good thing, okay? And we will have a question coming up about unqualified. Okay, so that was the audit report. That was from the auditors to the board of directors and shareholders. So that's our assurance that the auditors did not find anything material. So this gives us, as investors, as creditors, as users of the financial statements, some assurance that Smuckers is just not out doing its own thing. It had auditors in. These auditors, Ernst & Young, are very well respected. They answer to the PCAOB. They have peer reviews that they went in and they didn't find anything. So we can have reasonable assurance that things are okay at Smuckers. Okay, so next letter, and again, I'm going to blow it up so we can see it. but this one is the report of management. So this is management's report to the shareholders and of the Smucker Company. So it's signed by Richard Smucker and Mark Bell, I can't pronounce his last name, but it's signed by the CEO and the CFO. Okay, so the CEO and the CFO, the Chief Financial Officer, are both signing this letter. So this is the letter that's included in their annual report. It's addressed to the shareholders. This is management's report on responsibility for financial reporting. So remember, we just went through the auditor's report, the audit report. So now we're going to see what management, what top management, the CEO and the CFO are saying. So first paragraph, this is management. It says, the very first sentence of this report says management of the J.M. Smucker Company is responsible for the preparation, integrity, accuracy, and consistency of the consolidated financial statements. Okay? So they are saying front and center, management is responsible. That was what came out of the Sarbanes-Oxley Act. That came from Enron directly, from the fallout from Enron. Management is responsible. So if you aspire to be a manager, a top manager, you are responsible for the financial statements. That's why this class is important, even though it seems unrelated to what you're going to do. As you progress in your career, you are going to be responsible ultimately for this. There is jail time if things aren't right. So this is big stakes potentially. Okay, so the CEO and the CFO are saying management is responsible, and they've prepared everything in accordance with U.S. GAAP. Okay, so paragraph 2. We maintain systems of internal accounting controls supported by formal policies. There's a program of audits performed by our internal audit staff. Okay, so they're telling us that Smuckers has an internal control system. They're also telling us that Smuckers has internal auditors. Okay, so we've talked about auditors to this point. When we talk about our accounting firm, our auditing firm, our CPA firm, that's called an external auditor. So external auditors are an independent firm that come into the company and examine what's going on and issue an opinion. And they're independent because their fee is paid by the company, but they kind of march to their own drummer. They report to the board of directors, to the internal control committee. They don't report within the company. External auditors do the audit. Now, companies also have internal audit departments, and those are internal auditors. Internal audit departments are designed to do some of the same things. They live there all the time. They typically report to the board of directors as well, but they're actually employees of the company. So what their function is to do, they're designing internal controls for management. They're helping management with that. But they're testing things throughout the year to make sure things are working. We don't want a situation where once a year somebody comes in. That's too late if things have been going on. So internal audit departments are to make sure that things are running smoothly through the year. And internal auditors are also focused on efficiencies. They'll go through and test to see whether there's ways that the company could save money, if there's better ways of doing things. They're also testing constantly to make sure the company is following its own procedures and policies. If you work at a company and you have surprise cash counts, I used to work at a bank, and our internal audit department would show up at branch offices occasionally first thing in the morning to do cash counts. That was our internal audit to make sure that people knew that the cash counts could occur, and to make sure, just test things occasionally. So the internal audit department is part of the company. It maintains it to help as part of its internal control system, but those are internal auditors. The external auditors do the audit. Okay, so it's telling us, Smucker's CEO and CFO are telling us that they have an internal audit staff, and they evaluate the adequacy of and adherence to internal controls, policies, and procedures. Okay, so Smucker's has an internal audit department, and I think all large companies have to have an internal audit department as well. Okay, paragraph 3. So this is the CEO and the CFO of Smuckers talking to the shareholders. They say Ernst & Young, an independent registered public accounting firm, has audited our financial statements in accordance with PCAOB, and management has made all financial records and related data available to Ernst & Young during the audit. Okay, so this is kind of mirroring what Ernst & Young told us in their letter, that they audited in accordance with the PCAOB standards. Okay, paragraph 4. Our audit committee comprised of 4 non-employee members of the board of directors. So Smuckers has non-employee people on its board of directors. An example, our dean for the College of Business, the old dean, not the current one, but the one we had before this one, now sits on the board of directors for Smuckers. So he doesn't have any financial ties to Smuckers, but he's on their board. Meets regularly with Ernst & Young and management to review the work of the internal audit staff. So this committee on Smuckers' board of directors, these are non-employees. These are board of directors that come in from outside, and these 4 board of directors for Smuckers, they meet with the external auditors and the internal auditors and management to make sure things are going according to plan. Okay, the audit committee also regularly satisfies itself to the adequacy of control systems and financial records. The director of internal audit department is required to report directly to the chair of the audit committee as to internal audit matters. So if the internal audit department finds anything, they don't report to the controller or the CFO. They report to the chair of the audit committee, which is an outsider. That's so that if things were going on in the company officers couldn't say to the internal audit department, oh, be quiet. If you want to keep your job, don't say anything. The internal audit department reports to this audit committee. Okay, in paragraph 5, it is our best judgment that our policies and procedures provide reasonable assurance that our operations are conducted according to law and in compliance with the highest standards of business ethics. So that was another requirement of Sarbanes-Oxley, that we have a code of ethics and that we talk about it in the report. Okay, so that's what the report says. It says it's management's responsibility, and here's what we did, and here's how things run at our company. Very much boilerplate language, so if you looked at a different company's management letter, it's going to look very similar. Okay, so we're going to do a couple questions now. Okay, first one, audit report. Address is addressed to the board of directors and stockholders of the company. Okay. The audit report. So this is Ernst & Young talking to who's it addressed to. So we saw this, I'm going to go backwards for a minute here. The report that we're talking about is this one. I'm going back to it so we can see it. Okay. This is the report of the independent registered public accounting firm. So that's the auditor on the financial statements. Where I've got circled there, it says board of directors and shareholders of the J.M. Smucker Company. So this is the audit report. Okay? So keep that in mind. Okay, so audit report is addressed to the board of directors and stockholders of the company. Stockholders, same as shareholders, true or false? You've got about 15 seconds left to answer this one. I'm not putting up the answer first if you're waiting for that, because I just gave you the answer. Okay, an audit report is addressed to the board of directors and the stockholders or shareholders of the company. True or false? What do you think? Okay. That is true. Okay. It is addressed to the board of directors and the shareholders or stockholders of the company. There is no difference between shareholders and stockholders. They're synonyms. Okay. Okay, next one. It is the independent auditor's responsibility to determine whether the company's financial statements comply with generally accepted accounting principles. It is the independent auditor's responsibility to determine whether the company's financial statements comply with generally accepted accounting principles. True or false? Okay, we're going to try to move the needle on this one here. Okay, management's responsibility. So this question is about the auditor's responsibility. Well, I'm going to go backwards for a minute. So management's responsibility is the financial statements, to say we prepared them, we maintain internal control, we're responsible for these numbers. The auditors, on the other hand, the independent auditors, their responsibility is to determine if those numbers are right and if they comply with generally accepted accounting principles. Okay? So management is responsible for preparation. Auditors are responsible for to determine if they comply with the framework, with generally accepted accounting principles. So management's responsibility for preparing the statements. Auditors, do they comply with the accounting framework with generally accepted accounting principles? Okay, 10 seconds, and we're going to close this one. And that is true. Okay? Okay, next up, I've got some more examples that I pulled from real statements of a couple different things. So again, this isn't stuff you need to memorize. This is Smucker's, I'm going to blow up the part that you need. This is Smucker's financial review. So Smucker's, in its financial statements, it has item 8 in the annual report, which is saying, here's our financial statements, here's the full, all our financial statements, here's the management letter, here's the audit letter, here's all the notes to the financial statements. But before that, in that management discussion analysis part, they have a summary of selected financial data. So this is like the crib notes, the crib sheet. Here's a little cheat sheet on a summary of what's gone on. So instead of looking through all that just to get a quick idea, we can see this 5-year summary of some selected data. And when we look at this, it's really small, but it gives us some key numbers off the income statement, off the financial position, liquidity measures, and share data. So what I wanted to do here was kind of blow that up a little bit. First of all, it gives us some key information off the income statement. And what it does is gives us net sales and gross profit, operating income, and net income. But the reason I pointed this out, and this is for 5 years, the reason I pointed this out, there we go, okay, I don't have it circled, is it's giving you some of those same measures of earnings quality that we talked about on Monday. So right here, it gives us gross profit as a percent of sales. So you see with Smucker's, back in 2010, they had 38.8%. That was their gross profit as a percent of sales, and then fell a little bit to 37, then 33, and then it started climbing again, 34, and now 36. So they had it up here, they dipped a little bit, and now they're an upward trend. And then they did the same thing with operating income as a percent of net sales. And so Smucker's is trying to show you there some of their measures of earnings quality. So when you look at an income statement, a financial report, sometimes you'll see this kind of data the company's giving you so you don't have to compute it yourself. Also, on that same statement, it gives us some share data. It tells us the number of weighted average shares outstanding, and then the next one down, weighted average shares outstanding assuming dilution. Are they the same numbers? No. They must have some convertible shares out there somewhere. And then it tells us the dividends declared per common share, but the last two lines, they have net income per share, they have the earnings per share, and then they have assuming dilution. So you're seeing they're reporting their earnings per share. Their earnings per share in 2010 was $4.15, fell a little bit to $4.06 in 2011. 2012 was $4.06, and then it popped up to $5 per share in 2013 and $5.42 a share in 2014. So they had a little dip in 2012 across the board, it appears, but they're on an upward trajectory now. So that was just to show you that some of the things that we've talked about appear all throughout their annual report. Okay, this is Avery Dennison. Avery Dennison, in my mind, is best known for the labels. You would get the Avery labels. They would make name tags and labels, address labels. This is their income statement, and the reason I'm showing you this is we talked on Monday about income from discontinued operations. If you look at their income statement for 2014, they have income from continuing operations. Then the very next line is income or loss from discontinued operations net of tax. So it's exactly what we said on Monday. It's shown net of tax. And what is that discontinued operation? They actually, in 2013, sold their division that I always think of as Avery Dennison. They sold the division that has the name tags and the labels. That you go in to OfficeMax and buy the boxes of labels, the Avery Dennison. They are no longer owned by Avery Dennison. They sold the Avery brand labels. So that was kind of interesting. So you can find a lot of things in your reports. Okay. Here's another question. The audit report is signed off by the corporation's management confirming the audit was completed properly. Register your answer, and then I'm going to talk to you about this one because you can reason your way through this on this one. Okay, let's dissect what this question is asking. The audit report. The audit report is the letter from Ernst & Young to the shareholders and the board of directors. That's the audit report, okay? So the audit report is coming from Ernst & Young, who are the auditors. And the auditors are saying, here's our audit report, okay? And they're signing it. Do you think management does or should have the say over whether what that report says? No, it would completely defeat the whole purpose of that report if management had to sign off on it, right? Because this is the audit report. This is the independent auditor that is making a report about what went on. Management should never have any say over that report. Okay, again, I'm not putting up the answer, but you should, this is saying the audit report. The audit report is issued by, in Smucker's case, Ernst & Young is their independent auditor. The independent auditor reports to the board of directors and the shareholders and says, everything's okay, or here's what we found. That is an independent auditor. The independent auditor issues its report. It's looking to see if everything's okay. It would make absolutely no sense to have management have to sign off on that. Management is who they're evaluating. So you would not have management sign off on this report. It would ruin the report if management had to sign off on it. Are we close on number of people answering? Okay, we're going to close in 10 seconds. This one. Ready? Okay, and that is false. Okay, we're going to do one more here. An unqualified opinion, remember we talked about that, by independent auditors indicates the fairness of the company's financial statements and the effectiveness of its internal controls. This is saying, does the financial statement reasonably represent, fairly represent results? Okay, the majority of you have the right answer here, but I want to make sure you understand when we talk about an unqualified opinion, an unqualified opinion is a clean opinion, and it is stating that the company's financial statements are fair. We're going to close this question in 10 seconds. So an unqualified opinion is what a company wants. It's a clean opinion. It's saying that these results present fairly the company's financial position and the internal controls are fair, effective. Okay. One more page of notes. This is your last page of notes for this chapter, by the way. Okay, sometimes companies find mistakes from prior periods. Hertz, the rental car company, has been continually finding errors from prior periods. It happens. Despite everyone's best efforts, sometimes errors happen and are discovered later. When we find something that happened in a prior period, meaning last year or the year before, it's called a prior period adjustment. Okay, a prior period adjustment. This means we found an error in revenue or expense from last year or the year before, some earlier year. So if we found a huge error in sales revenue from last year, we don't want to write that to sales this year because then it distorts this year. So it's a prior period adjustment, and we're going to correct it, and whenever we correct a prior period adjustment, this revenue or expense, it's going to go into retained earnings. So if I had to know two things related to this, correcting prior period adjustments, no, it's a prior period adjustment, and we always adjust retained earnings. We do not, so if it's affecting sales from last year, it goes into retained earnings, not sales from this year. If it's expenses, it goes into retained earnings, not expenses from this year. So if it's a prior year, we go into retained earnings. Okay. I have a question coming up on this slide. Okay. Now, the thing that you need to know from this slide is that we correct retained earnings for prior period adjustments. Now, revenue and expense items refer to revenue expense are on the income statement. So revenue and expense are called income items a lot. So I'm just trying to explain this question that's coming up. Okay, so prior period adjustment, something that we're doing to correct income from a prior period is going to be adjusted to retained earnings. Okay? So retained earnings, when you have automatically, you see revenue, you see expense, or you see income, you see those three things, any of those things need adjustment for prior period, you're going to adjust retained earnings. Okay? Okay, here's our next question. A prior period adjustment that corrects income of a prior period requires an entry to what? Okay, a prior period adjustment that corrects the income of a prior period requires an entry to what? Okay, again, make sure we just talked about this, that retained earnings, prior period adjustments, we're going to adjust retained earnings for anything relating to an income amount. Okay, we're going to close this in 5 seconds. Is everyone pretty much answered? Okay. Okay, so retained earnings. And yes, if you are in the chat room, do not enter answers in the chat room. Okay, we have one final question for today then. Okay, so earnings per share is the amount of a company's net income per share of what? Okay, so earnings per share is the amount of a company's net income per, now, okay, so earnings per share, it's going to be, the formula for earnings per share, we did this on Monday, but the formula is taking a company's net income, subtracting preferred dividends, and divided by the weighted average number of common shares. Okay, so we take the net income, we're going to do this. Okay, so 10 seconds to get your answer in. Ten seconds from this point, we're going to close this question. Okay, and that is all I have for today. I think we worked really hard up to this point. I don't want to provide filler. So that's it. Chapter 11 is due this weekend. Have a nice weekend. They tell me it's going to be 65 today, so enjoy the weather, and I'll see you Monday.